Most investors are terrified of Bitcoin, and yes, they are right about this feeling. Crypto in general is highly volatile, and immediately stay away. But what if I told you that in 2026, that exact volatility, the very thing that scares them, is the fuel for a 100% annual yield? In part 1 of this series, we built the safety base, using treasury-style income ETFs designed to provide stability and predictable cash flow. We've covered the 60% safety base. In part 2, we added the tech overlay tier, where option income strategies on large tech companies create higher distributions while still sitting on top of established businesses. We've covered the 30% tech overlays. But today, we're stepping into the top layer of the pyramid. We're entering the 10% turbo tier. This is the smallest slice of the strategy, but potentially the most powerful. These are crypto-linked income ETFs designed to turn volatility into weekly paychecks through option strategies. If you're an American investor sitting on a stagnant 401k or a Roth IRA that's barely keeping up with inflation, listen closely. We aren't just buying crypto here. We are harvesting it. We are using the leaking bucket strategy to turn the world's most volatile asset class into a predictable Friday payday. But before you get excited, there is a critical warning that almost no one on YouTube explains properly. These funds can generate massive income, but they also come with a real risk called NAV erosion. If you treat them like a normal long-term investment, you could watch your capital slowly shrink. Not the hype version, the real version. And if you use them correctly, they can serve as a small turbo boost inside a diversified income strategy. Let's get into the first ticker. Ticker 1, MSTY, Yield Max MSTR Option Income Strategy ETF. This is the most volatile income ETFs on the market right now. Just a quick one. MSTY doesn't own Bitcoin directly. It uses a synthetic covered call strategy on MicroStrategy, the company owned by Michael Saylor that effectively operates as a Bitcoin vault. Because MicroStrategy stock itself tends to move dramatically with Bitcoin, the options premiums can be extremely large. As of early 2026, MSTY is sporting a staggering distribution yield of approximately 105%. You heard that right. It is paying out more than its own share price in a single year through weekly distributions. Like most actively managed options ETFs, MSTY carries a relatively high expense ratio, roughly around 1% per year. While that's high compared to a standard S&P 500 like VOO, remember, you're paying for a team to trade complex options around the clock so you don't have to. Here is the strategy to the ETF. MSTY wins when Bitcoin and MicroStrategy go sideways or slightly up. It harvests the massive option premiums that traders are willing to pay to bet on Michael Saylor's moves. The key trade-off with funds like MSTY is this. You are exchanging potential upside growth for income today. If Bitcoin suddenly explodes upward, MSTY will likely capture only part of that upside because the covered call strategy limits how much the fund can participate in major price rallies. In other words, MSTY investors are choosing cash flow instead of maximum growth. You are trading the dream of the moon for the reality of the Friday paycheck. And for income-focused investors, usually in their 50s, that trade-off can make sense. Next up is the exchange play, CONY. This fund tracks Coinbase. If MSTY is a bet on Bitcoin's price, CONY is a bet on the noise of the crypto market. When people are panicked, they trade. When they are greedy, they trade. CONY loves both. CONY is currently delivering a yield of roughly 92.8%. It's slightly lower than MSTY because Coinbase is a more diversified business, but it's still firmly in our turbo tier. Coinbase tends to benefit when trading activity increases. When crypto markets become volatile, whether prices are rising or falling, trading volumes often surge. And when traders are active, the options market around Coinbase becomes more expensive. That's where CONY's strategy comes into play. Just like MSTY, CONY generates income by selling options and collecting the premiums that traders are willing to pay. Those premiums then get distributed to investors. Because Coinbase can experience large price swings, the option premiums can be significant. As a result, CONY has also shown extremely high distribution rates during volatile periods. The expense ratio for CONY is also roughly around 1%, similar to MSTY. And just like MSTY, the fund sacrifices some upside potential in exchange for income today. However, CONY has an additional risk factor that investors need to understand. Coinbase is a regulated financial company operating inside the crypto industry. That means its business can be heavily influenced by regulatory decisions, government policies, and changes in crypto trading volume. If regulatory pressure increases or trading activity drops significantly, the income potential from options premiums could decline. Here is the strategy. We use CONY to skim profits from the crypto world and move them back into our safer tech and treasury buckets.
Now, we need to talk about the biggest risk that comes with extremely high-yield income funds. This is something I call the leaking bucket problem. Imagine you have a bucket with $100 in it, and every Friday, someone hands you $10 from that bucket. At first, it feels incredible. You're getting paid every week. But if the bucket itself slowly shrinks from $100 to $90, then to $80, and eventually to $70, something important is happening. You are receiving income, but the total value of the bucket is declining. This is what investors call net asset value erosion, or NAV erosion. In some cases, distributions from option income ETFs may include return of capital, which means part of the payout could be coming from the fund's own capital rather than pure investment profits. That doesn't automatically make the fund bad, but it does mean you cannot judge the investment purely by the size of the dividend. You need to monitor the total return over time, including both price movement and income. How about taxes? Many distributions from option income ETFs are classified as ordinary income or short-term capital gains. Depending on your tax bracket, the IRS could take a substantial percentage of those distributions. For some high-income investors, that rate could reach up to 37% at the federal level before state taxes. Because of this, many investors prefer to hold these types of funds inside tax-advantaged accounts, such as a Roth IRA, where distributions can grow tax-free. That way, the weekly income stays inside the account without being reduced by annual taxes.
Who should use the crypto turbo tier? Now, I want to give you my honest verdict for 2026 because your strategy has to change based on the gray hair on your head, or lack thereof. Don't take my word for it, I'm just an investor like you, not a financial advisor. For 30 plus, you have something extremely valuable, time. In that case, a small allocation, say 10% of your portfolio, to the turbo tier, but inside a Roth IRA, and set it to DRIP, dividend reinvestment. Even if the NAV erodes, your share count will explode so fast that you'll be sitting on a mountain of income-producing assets by age 35. If you are in your 40s and chasing financial independence, this tier can act as a temporary accelerator for income generation. But discipline is critical. You must keep the position small and monitor the fund carefully. If the NAV drops more than 25% from your entry point, the bucket is leaking too fast. You rotate out and wait for a better entry. If you are approaching retirement, caution becomes even more important. Investors in their 50s and 60s generally should treat these funds as a speculative allocation rather than a core income source. You do not have the time to recover from a 50% crypto winter. It should be no more than 2 to 5% of your total dividend wealth. Use the distributions to take your family on a luxury vacation or buy that thing you've always wanted. It's for spending, not for surviving. Your safety base, the part 1 we discussed, is your life support. Never mix the two.
The weekly cash flow strategy works best when the pyramid structure is respected. The safety base provides stability. The tech overlay tier provides moderate income and growth. And the crypto turbo tier provides speed, but also the most risk. If you try to build a portfolio starting with the turbo tier, the structure becomes unstable. But if you place it on top of a solid base, it can act like a small engine that accelerates the entire strategy. Use responsibly. These funds can help turn volatility into income. Used recklessly, they can quietly erode capital over time. And that difference comes down to strategy. If you found this breakdown helpful, go ahead, subscribe to this channel, and hit the like button. It helps the video reach more investors who are trying to build smarter income strategies. Also, I'm curious about your opinion. Would you ever allocate a small portion of your portfolio to the crypto turbo tier, or would you prefer to stick with the safer base layers? Let me know in the comments. Thanks for watching, and I'll see you in the next one.